Hi, everyone, and welcome to the Sales Tax Compliance 101 for e-commerce sellers webinar. We're super excited to have everybody. I'll give everybody about a minute here to hop on. So in the meantime, if you want to, chat us maybe where you're tuning in from, that'd be awesome. We'll just give everybody, a minute or so to hop on. Awesome. I'm seeing the numbers kind of creep up a little, so we'll give everybody a couple more seconds and then we'll get started here. All right, we'll go ahead and get started. My name is Katie Dieter. I am the event marketing manager here at 8Fig. So you'll see me a lot on these webinars, playing host. Super excited for our guests today. We have the team from CLA. They're here to, talk sales tax compliance, in regards to your e-commerce business. So a lot of really good, useful information to come. I just want to do a quick little intro and then I'll let them sort of do their own intros and then we'll dive in. So we have Tom, he's the signing director at CLA. Then we have Stephen Claffin. I hope I'm saying your last name correctly. He is also a manager over at CLA. And then we have Jill Boland. She is a principal at CLA. And then we have Rance over at CLA as well. And he is a principal. So thank you so much for joining all of us today. In a second here, I'll let you guys do your intros. But first, a couple housekeeping things for those listening. We will send the recording after, after the webinar. So if you have to hop or anything, totally fine. Recording will come to you within 48 hours or so. If you have questions throughout, please drop them in the Q&A. I know our panelists are really eager to answer some good questions today. So please be engaged. Please ask as many questions as you want. We love to see it. And with that, I will let, Team CLA kick it off and give us maybe a quick little intro on each one of you.
Thank you, Katie.
Yep,
So
absolutely.
I'm Tom Sanamaja. I'm a signing director here at CLA. I mainly do indirect tax consulting and, along with Steve and Rance, we are in the sort of sales tax group, and I'll let them speak about what they do here. We do a lot of consulting and sales tax compliance with global clients, global inbound. Jill is part of the discussion today to discuss federal income tax implications. And with that, I'll hand it to Steve to introduce himself.
Yeah, thanks, Tom. Thanks, everyone, for joining. My name is Steve Claflin. I'm a manager. I'm out of our Charlotte office, and similar to Tom, focusing on indirect sales tax consulting, a lot of remediation, BDAs, and also before I joined CLA, I worked at Sobos, which is a sales tax automation engine, for about 3 years as a tax counsel. So have a little bit of background in the automation space. Rance? You're on mute.
Mute, Rance.
Got it. Sorry, guys. I knew someone would do it. Didn't know it would be So Rance Morton, I'm a principal in our Dallas office. And like these guys, I'm in the SALT group, which if we use the acronym SALT, that just stands for state and local tax. So I predominantly work in sales tax, and I lead our sales tax outsourcing group. So what that group does is we file returns for clients all across the country. So from, one state all the way up to every single state, plus the different locals that we'll talk about today as well. So if you need any assistance, definitely I'm the person to start with, and I have a team all across the country. So if you ever do have any specific issues, we are spread out. So we're in different locations, which we do that on purpose so we can collaborate across state lines. So if you have any specific questions, definitely let us know. And I'll pass it over to Jill.
Thanks. Jill Boland, I'm a principal at CLA as well. And as Tom mentioned, not in these words, I'm a bit of the odd duck here, while everyone else is involved in state tax. I help with U.S. federal tax, but specific to international tax issues, whether that be a U.S. business that is owned by non-U.S. individuals or entities, or a U.S. business that has non-U.S. subsidiaries or investments. On consulting, similarly, financial modeling, structuring on both sides, inbound and outbound. And I also work with our transaction tax group in terms of mergers and acquisitions that have some type of cross-border element. So you'll hear from me toward the end. So the weird interspersement of tax. So with that, back to you, Tom.
Thanks, Jill. Katie, next slide, please. Next slide again. That's just housekeeping right there. So we want to get to some learning objectives today, right? So this is we want to encourage discussions, dialogue, not just us sort of talking about this, So what we just want to give you is just the high level learning objectives here. It's going to be overviews. There's sales tax overview. What is the tax, generally speaking? This concept of nexus, kind of how you want to look at taxability, so now you go through the steps, say, okay, what is it? Am I required to collect it? And then how do I get it to the respective states? And then, Rance is going to focus on maybe some special considerations for certain industries, certain products. And then to Jill's point, there's also federal tax considerations. Next slide, please. Right. So what is sales tax? Right. It's different than the value-added tax. So sales tax, generally speaking, is imposed on the retail sale of tangible personal property, unless that property is specifically exempt and or specifically enumerated services. And the way that it differs from a value-added tax regime is, essentially with the value-added tax, everyone's paying their own sort of tax at each level. Whereas in the US, sales tax is due once when it's a retail sale to the ultimate consumer of either the good or the tangible personal property. So unless it's a retail sale, there's technically no sales tax liability, but there could be, other administrative considerations like exemption certificate collections, whether that's a resale or whether that's a specific exemption that applies to the product. So another thing to consider here, sales tax is a trust tax. So essentially, you as a vendor, you as a seller are basically stepping into the shoes of the state. And if you have sufficient nexus, that state is requiring you to collect the tax from your customer. So it's not necessarily an economic burden, if you will, outside of the administrative costs for you as a vendor. It's more on the consumer. However, if a state audits you before they audit your customer, they can get the tax from you, and then you would have to essentially use the available avenues to indemnify yourself from your customer, essentially get that tax back from them. Again, if tax is collected, whether it's done in error or not, pre-nexus, you have to remit it, right? Because it is a trust tax. And out of the 50 US states, there are the nomad states. Those are the 5 states that do not impose a sales tax regime: New Hampshire, Oregon, Montana, Alaska, and Delaware. Next slide, please. Again, just to hit home these general rules of sales tax. Sale of a tangible item is taxable unless the customer claims an exemption or there's a specific exemption in that state for that product. Sales tax for tangible personal property is generally imposed at the location to where the property is delivered or title is transferred. So it's not, right? We get a lot of questions. Well, I'm billing them in state X, but the product ends up in state Y. Which state's rules do I look to from a sales tax collection perspective? Do I look to where I'm billing, or do I look to where it's being delivered? Oftentimes, with tangible personal property, because it's due at the moment the title is transferred, it's where it is getting delivered. That's where you're going to look to that state's rules. That's where you're going to look to that, the essentially the rates that are applicable in that state, local jurisdictions, cities, so on and so forth. Next. So again, although a few states tax all services unless an exemption applies, so for example, Hawaii, New Mexico, South Dakota, and West Virginia are states that have a broad tax base for services. The sale of a service is generally not subject to tax unless the statute specifically addresses it. So, some common examples of taxable services include security services, pest control services. In the technology realm, this is where it gets very dicey and subjective, and a lot of analysis is needed. Some states tax informational services, data processing services, software as a service, that sort of thing. From the context of this discussion today, let's assume everyone's selling a widget into the US and then shipping it into the States. The service that you're really sometimes going to be concerned about for the most part is delivery fees, right? Shipping and delivery fees. Some states tax them based on how they're presented on the invoice. Some states don't tax them, and some states are just going to tax them regardless of how they're presented. Next, please. So, we've talked about the generalities of sales tax, but really, I guess, I always say you don't really care if something's taxable in a state until you have nexus in that state. And really, nexus is essentially just a term that says the state's ability to impose its tax regime on you as an out-of-state taxpayer. So you have to have what's called substantial nexus in a state. And historically, it used to be you had to have a physical presence, right? And that could mean a myriad of things. You had a retail location there. Maybe you had employees residing there. You had employees traveling into that state for business purposes. You could even have third parties who are, truly independent agents acting on your behalf. So long as they were exploiting or creating a market on your behalf, there was enough physical presence there for a state to basically say, hey, you have to collect our tax. There's what's called, affiliate nexus. So if you have several different taxpayers that are affiliated or related in some way, the physical presence of one entity could bring in another entity depending on what they were doing on each other's behalf. There used to be, this click-through nexus, which, based on Amazon, you would click a link, servers were there, that sort of thing. It would give you nexus. And now the biggest thing, right, in 2018, there was the Wayfair case. What it established is called economic nexus. So, we talked about, hey, historically, you had to have boots on the ground, so to speak. You had to have some physical presence, and it had to be substantial. And that, to be honest, was subjective, right? No states are going to say, hey, if you're there 2 days versus 2 weeks, that's what we consider substantial. But now that there's this economic nexus standard, it essentially establishes, what substantial nexus is just by selling into a state. Now, remember, there's kind of two buckets from a nexus perspective. There is physical, which, if you have $1 of sale, it's taxable if you have substantial physical presence. But aside from that, if you do not have that, now we're looking at economic nexus as kind of the second bucket, or the second way that the states can look at it. They can tax, they can essentially assert it one of two ways. Next slide, please. Unless, are there any questions right now, Kate, that you're seeing related to any of these slides yet, or do we want to?
We did have a couple of questions about economic nexus. So can you just describe kind of what the general nexus rules are? So the thresholds and sales thresholds.
Sure. So they're going to vary by state. But when I say that, right, that they're sort of the states that are some outliers that have a higher threshold than others. But for the most part, it is you have over $100,000 of gross receipts in a state or 200 transactions. Some states, right, use gross receipts, meaning even if you sell 99,000 of non-taxable goods, but you have 2,000 of taxable goods, there's your gross receipts. You've met that threshold. So you now have to file a sales tax return. Some states only say retail sales. Some states say taxable sales. A lot of these states that have this 200 transactions threshold are kind of getting away from that, right? Because the intent isn't to tax, 200 pencils at $1, right? The intent is how are you economically exploiting the market? You're selling $100,000 worth of pencils. However, that being said, they do have these rules on their books that, if you have a transactions threshold and you exceed it, even though you're not exceeding the gross receipts, you're technically required to file sales tax returns. Are there any other questions that I should probably address before we move on? Okay. And then, oh, go ahead.
I was just saying I didn't see any, but as they come through, I'm not shy to interrupt and ask, so I'll let you know.
Fantastic. Interrupt away, please. Right. And then now we've got Amazon, we've got these marketplace facilitators. So kind of two things at play here with Amazon. There's the nexus creating activities that could happen, right? Because if you have inventory in Amazon fulfillment centers, that gives you that historical physical presence nexus, right? So there's kind of one thing that goes on. And then another thing, when we're talking about this economic nexus, a lot of states say, look, Amazon and similar marketplace facilitators, essentially what they do is they step into the shoes of you as the retailer. They're responsible for collecting the tax. Oftentimes you'd have to look at, well, okay, if I sell both from my own website and through the Amazon platform, right? Do I look at total combined sales from an economic nexus perspective, right? Or am I able to take out the Amazon sales, because that's not really going to be factored into whether I, as a standalone company, right, selling from my website only, have economic nexus. Next, please. So I'm going to hand it over to Steve to discuss these other items, and then he'll hand them to Rance and Jill as we see fit.
Thanks, Tom. So now that you kind of understand Nexus, or at least, a pretty high level, again, the purpose of this presentation is just to kind of keep things at a high level, but technical enough. So hopefully you kind of learn enough concepts to know when to ask the questions. But as far as, take an example, you have Nexus, you have Nexus in, these 5 states or whatever, in the Southeast. That's your market. You have a traveling salesperson kind of going around, or you have over $100,000 in sales into these states. Okay, we know we have Nexus, so then what? And Tom kind of alluded to it earlier, is the product taxable that you're shipping into the state? And that's the most important part. It's the next step in inquiry, because if it's not taxable, you don't have any tax to collect. Whether you need to file zero due returns, it's dependent on the state. Generally, it's not recommended, but if it's taxable, you want to make sure you are collecting the tax, because as Tom said, if you're not passing along to that customer, if you get audited down the road and you aren't able to collect it from your customers, that's going to have to come out of your pocket, which obviously we don't want. So we want to make sure we get taxability. We want to make sure we get Nexus right. We want to make sure we get taxability right. And kind of the purpose of this, the next few slides, is to kind of talk about the complexities of taxability and maybe some ways to leverage software to make it a little bit easier. When it comes to taxability, Tom said it, if it's a general, it's a widget. If it's a desk chair, if it's a, computer monitor, you're generally going to be taxable in just about every state. There might be some nuance to that. I think Rance is going to talk a little bit about some common exemptions. Think about like food, medical devices, things like that. That your product might fit into, it might not. There's when you talk about digital products, it's a little bit more nuanced. Whether it's software as a service, downloaded webinars, things like what we're doing today. If it was charging, if it was a sale and charging for it, is that a taxable sale? It is in some states. So, there's a lot of nuance around digital products. Also with services, is the service taxable? A lot of standalone services, if you think about professional services, things at CLA, providing consulting services, generally not taxable, although there are a few states like South Dakota that do tax it. But those standalone services might not be taxable in most states, but those services that are attached to the sale of tangible personal property in a lot of states are. So if you think about shipping and handling, it's a little complicated, but handling services are almost always always taxable. Installation, if you're doing some installation, repair work, things like that, are pretty commonly taxable. And we've definitely seen some states start expanding the tax base over the years to start taxing more of these items that they kind of have before. So more of these, additional services that might be attached to a sale are becoming more and more taxable. And then, so you have a taxable product, you have Nexus in the state, your product's taxable in the state. Okay, well, what about tax rate? How much tax do I collect? It sounds like it should be pretty simple. The problem is in a lot of states, there's different layers of taxation. So there's some states like Massachusetts where it's just a state rate. All it is, you put 6.25% on all your invoices and you're done. And then there's states like Colorado and others that have a state level, they have a county level, they have a city level, and they might even have an additional special district. There's divisions in Colorado, say like a new mall, a new development, they have what's called public improvement fees on, which is essentially just another 1 or 2% tax rate that a business needs to collect. So if you just know this, where your product's going, in some states it might be easy to just kind of look up a manual rate. But if you're doing that in thousands and thousands of transactions, obviously it's not possible to do. And that's where some level of automation comes in. Next slide, please.
Actually, I'm going to pause you. There is a question that may pertain to, some of these slides
sure.
here.
Yeah.
So someone had asked, how should ecom businesses handle the taxability of returned goods? Is there any documentation necessary to support these transactions?
Yeah, no, it's a great question. As with everything, documentation is huge. So as long as you're crediting back the product and you reported tax on it, then you essentially will just take credit in your current return for the amount of tax you paid. So if you remitted $20 last month and on the sale and tax, and the product came back, and the next month you just reduce your taxable sales by that $20, and you become whole as if the kind of transaction didn't happen. If it happens in the same period, you can just offset it and just never report it. That's a little bit easier. But I always say a lot of returns might happen in different periods. States do have some states have rules around, should you have to amend your return? If you're going to generate a credit, so if it's a really large transaction, and say you collected $1,000 in tax and remitted $1,000 last period, and this next period you only have $100 in tax to remit, how do you get that $1,000 back? You're probably going to have to amend the prior return and submit documentation that we had a refund, we need this $1,000 back, and go through that process. Unfortunately, there's no real easy way to do it. Every state kind of has its own way. The most common practice is just take credit for it in your next period, and you're whole. But again, if you don't have enough, tax in that period to cover the return, which might happen if you have really large dollar transactions, that's when you kind of have to go through a refund process. Great. So kind of talking about a little bit more about automation and kind of the methods of A, collecting the tax, and B, determining taxability. And they kind of go hand in hand. And the first is just a manual method. We definitely have clients out there that make very high dollar, low transaction sales, and they have the ability, they can, determine the taxability based on the state. They reach out in real time. Hey, we're working on a contract in this state. They're in Colorado. Is what we're going to sell them taxable or not? And we can kind of give that feedback in real time. And then if they go through the sale, they can look up the rate. Pretty much every state has a manual lookup, and they can invoice it. Obviously, it's not the best way to do it, but when you're talking about growing business and new business, and really only a few transactions a month, it's something you can certainly do. Then there's the kind of the hybrid approach, which when we say collected tax, when it comes to tax rate, we have what's called rate tables, and when it comes to taxability, we have tax matrices. Again, these are really high level. Rate tables are great. Some companies will sell them, some won't. They put a lot of work into updating their rates, so some companies have been kind of hesitant to sell them, and some aren't. The important thing with rate tables is to make sure you get updated, because obviously it's a table, you're just getting Excel. It's not going to update itself. So cities can update as frequently as monthly. Depending on your sale amount, maybe a quarterly. It makes sense to at least quarterly get new rate sheets from the company. And also, if there's an issue with a rate table, maybe a month later, the company found out, hey, they had the wrong rate. You're not going to get that pushed through like you would with the sales tax software. So it just, you have that little bit of lag. But again, if you're talking 1%, 0.5%, and you're only talking a month or two in sales, and you're not, a $1 billion company, maybe that risk isn't too much, and a rate table makes sense. Kind of similar with the tax matrix on the taxability side. Tax matrices are really high level categories, and what essentially would be a category of computer hardware. Is it taxable in all these states? They'll basically just say yes or no. Now, this is great for something that fits into a really clean category, like an apple, clearly fits within fruit, clearly fits within food. You can, you're pretty comfortable with the way that's going to fit in there. But when you get into some of these digital products, or a kind of a broad category that tax administrators might not specifically identify, that's when a state might have a little bit of nuance, and you might be over or under taxing depending on the product. But again, it's going to probably get you 80% plus there. And then you can also research kind of those states that you have primary sales in and say, okay, no, these are our top 3 states. We agree. We feel a little bit more comfortable with that. And then the last model is the automation, which, as companies grow, it's definitely makes sense to at least look into it. Obviously, downside, it's costly. It's not cheap. If you've looked into it, you know that. And it's not a small project to just implement an engine. They can certainly bigger company, more product SKUs, the more and more of that implementation is going to be. But the end road is going to be, you got to be very comfortable with your taxability determinations, because you're gonna map all your codes to these product codes, and so even if you start now, all of a sudden you hit 5 more states through a nexus, and you need to start collecting in Iowa and in Minnesota and New York. Well, that tax engine already knows the taxability, and you already have your product mapped, your apples to food, and it already knows the taxability or the computer hardware. And once you turn on that state, it's just going to start collecting taxes if your product is taxable or not. So they're great products, and when it comes to rates, it's just automatic, flows into your ERP or your e-commerce system. Now, with that said, there's a lot of e-commerce systems that have built-in rates. So if you're using a Shopify, basic Shopify has a built-in rates that you can pull from. I haven't really seen any issues with those. It's just there's no that robust taxability engine behind it. So if you're just selling one product, it's kind of taxable everywhere, pretty simple, and you just need to pull rates, that might be a solution. But you don't have that kind of robust taxability support.
Right. And Steve, sometimes like Shopify is good because it has general rates based off ship to location, but it's not as sophisticated as a sales tax engine. Some examples of that is there are some reduced rates. So like in Connecticut, like data processing is taxed at a 1% rate. So if you had a product that fit in that category, Shopify wouldn't be able to do it. There's a lot of states that have food that's taxed at a reduced rate. So sometimes it's just the state rate, sometimes it's just the local, whatever it is, and it doesn't have that sophistication. So if you were to do that 100% correct, you would likely need to get a tax engine like an Avalara or Vertex, bolt that on to Shopify. So then it's not using their rates, it's going through the tax engine to determine the correct amount of rates. So usually if you're in a sophisticated or you have a very vast website with a lot of different products and services, you might want to consider that sales tax engine depending on how risky it is. And I think you're going to address that in a few slides.
Yeah, no, that's a really good point. I mean, we've had clients that, they wanted it's the same context. They sell food. They wanted to use Shopify Basic. We realized that they couldn't because you had to manually essentially program everything. It just couldn't work. And they had to get an engine. And there was just kind of no way around it. Also, as kind of Rance mentioned, the software also will address validation that these, Shopify, these platforms kind of won't do. So they'll go through a process and basically cleanse an address and try to get to the most accurate address. Because in some states, if you put just a 5-digit zip code in, it might produce 3 different rates, depending if you're in city, in county, out of the city. So the address and the sophistication of getting this rate really it becomes a big deal, especially as you get more and more sales into that state. Okay, next slide, please. And so what we provided here is just some of the most common providers out there. We work with all these, our customers, our clients do as well. I think all of them kind of have pluses and minuses. But one of the biggest things that we've seen for our clients is in picking them, cost is always, probably one of the bigger deals. Customer service, how they felt during that sales process. But really it's integration. How does that platform, is there a plug and play? Is it going to automatically feed in? For a long time, Shopify had a exclusive relationship with Avalara, Avatax, And so it would just, all you had to do is pay, or if you had Shopify Plus, it was already included, and just essentially turn it on and everything flows through, and it integrated, terrifically. I think that program's kind of lapsed. I think Vertex is now a partner. So there's a little bit more flexibility there. TaxJar is owned by Stripe now. So Stripe already kind of embeds that engine in it. And TaxJar is kind of one that's kind of come along over the years. It's kind of a growing. The other was, Sovos and Avalara and Vertex and Wolters. They've been around for a long time. They have really robust product catalogs, thousands and thousands of categories. Maybe that's not needed, but maybe it will be down the road. So I think it's just a matter of, reaching out to multiple providers and talking to them, see how the integration will be, getting their cost, see their product catalog, make sure it's right for you. And that's certainly something we can always help with too. And we've had a lot of calls with clients with these providers to see, what platform are you using? Do they have an automatic, plugin, and how will it kind of work? Great. Next slide, please.
There's actually one question maybe we can just answer real quick before we continue. But someone had asked, how would you recommend preparing for a potential sales tax audit?
Yeah. Ideally, kind of prepare ahead of time and just kind of prepare in real time and just keep your documentation as well as you can. I know that's easier said than done. You're running a business and it's difficult. But if you were selected for an audit, it's just really just a matter of just getting the documentation together. As an inbound seller, it's going to be a lot easier because really it's just sales. If you do have a domestic presence, so say you have a distribution center in Georgia, and you have some employees there, and you have your purchases there, they're also going to want to look at the purchase side. So you want to make sure you have your purchase invoices and see if those have been reviewed. Have you been charged sales tax on those purchases if they're taxable? Most states have a distribution arrangement, you're taxable, but if you're doing manufacturing domestically, there's a lot of exemptions that might apply. So you want to make sure, on the purchase side, really all your major purchases were taxed or you would use tax. And on the sales side, isolating those sales into that state that, picked for audit, making sure that, those that you collected sales tax if you did. So I guess it matters if are you registered and filing. If you're registered and filing, it's just going to matter down to when did you start registering. You want to make sure you don't have any exposure before, or if you did, just make sure you know that's out there. Sometimes the discussion becomes, well, when did you register? July 1st, 2022. Should you have registered earlier? And they're just going to look at your sales. And if you should have registered a year earlier, you just got to kind of know that you're probably going to be on the hook for that, those sales and that tax that wasn't collected for that period. So I think it's getting a kind of a good understanding of what potential liability might be out there, and really just gathering the documentation. I'd probably reach out to your tax consultant too, to at least loop them in and say, hey, maybe we just have a half-hour call to kind of go over it and kind of see what's out there and talk about next steps.
So kind of to piggyback a little bit off of what Steve's saying, right? It really depends on what your revenue streams are, right? If you sell a pen, that's taxable in every state. So your concern for the most part would be, all right, did I sell it to resellers? And if I didn't charge tax. Did I get the proper exemption certificate? Or, maybe another layer of a concern there is, shipping and handling, delivery charges. How does that state tax that, right? So, because the way, to Steve's point, the way sales tax audits generally work in most states, you're looking at the revenue and the purchase side, right? If all you're doing is selling, you don't have any, physical presence there, it's really going to depend on what your revenue streams are. So if you're in the technology space, like let's say digital goods or software, that's going to be a little bit more complex than if I'm just selling a pen and I'm just, selling it to an individual. Most states look at from a audit perspective, they're sampling when they're looking at, your sales. So that's another thing too. I think Steve brought up a very great point to get maybe ahead of what do we think could be an issue if and when the auditor comes here, right? Was there any month where maybe we, our ERP system was down? Is there any sort of time where we felt like we didn't really have a handle on tax? Was there a time where, as Steve was alluding to, that we had Nexus, but we didn't register? getting ahead of that. And, at the very least, kind of knowing what that potential exposure could be.
Right. And from the resale and exemption certificates, that's probably the biggest contention that I see. So the team on here, we do a lot of due diligence projects, and that's usually one of the first questions they get. It's like, okay, you have a lot of non-tax sales. Where's all your exemption and resale certificates? And a lot of times they're like, we don't have them. What do we do? And so that's a good thing to do every couple of years, is kind of do a refresh or right before an audit. Basically go through all your exempt customers and make sure you do have those reseller exemption certificates, and to make sure they're completely filled out. And that just means all blanks have to be filled in, because we see it a lot of times where someone will give us a certificate and it doesn't have our customer's name on it or client's name on it. And it's like simple things like that can disallow a certificate. It might not be dated. It might be signed, but not dated. So basically doing a scrub of those before the auditor gets there is great, because then you have the ability to go back and get an updated version before you send it to the auditor.
Yeah, if you're a company that makes a lot of exempt sales, you have a lot of distributors, things like that. That's another place that software can really help automate that. Most of these tax providers have some sort of solution where you essentially input the certificate into the system, and then it connects with the ERP system. It flags it as exempt, but it also kind of goes through a process of storing it. And if you need to do what we call like a sales tax collection campaign, like Grant's alluded to, you never collected them. You're trying to sell the company. Whereas guaranteed it's going to come up in due diligence. The buyer's going to tell you got to get all the certificates, otherwise this is all potential liability. And to kind of run those campaigns, you can use software to kind of reach out to all your customers, kind of a canned, hey, please upload your response. And then it's a matter of reviewing them too, because like you said, purchasers will provide kind of blank documents. We've seen just about anything. I've seen an IRS letter from 1986 saying that the company doesn't file federal income tax, as if that has anything to do with state sales tax. So important to review that and stay on top of exempt certificates, because that probably is the number one audit issue as a seller we've seen recently, that can really be mitigated by just getting those exempt certificates up front as part of the sales process. Hey, is this customer exempt? Well, if you're going to input them as exempt into your system, make sure you have documentation to support it, and really just get that for any exempt customer from the beginning, and you'll be really in good shape down the road. And if you go to sell or come to an audit to provide those exempt certificates. Okay, sales tax registrations. It seems like it should be a pretty simple process, but it's really, it's just really inefficient. Every state has its own process. Every state asks for its own data. It's just if you have to register in 20 states, you have to go to 20 different state Department of Revenues. Pretty much all of them allow for an online application. But some of the issues we've seen, especially with inbound sellers, is if you don't have a social security number, so if you're not from the United States, there's no way to process an online application. So then you can still register, but you're going to have to do it with your paper registration. Pretty much every state will send a mailing with a verification number. Obviously, if that's going to an international address, that's going to take some time, kind of delay it further. As far as filing and paying tax, essentially it needs to be paid from a U.S. domestic account. If you use a third-party software provider to be the payer, that's one way around it, or you have to get a domestic account. So there's a lot of nuance, especially for inbound, on the registration side. And I think it's just important to know, there is a registration for every state, has its own process. Even some locals at the local level require it. So before you start collecting in a state, you want to make sure you register. But even kind of before you do that, one of the bullets on here is looking to see if you have any prior exposure. And that kind of gets us into the next slide, of either remedying or at least reviewing, identifying any potential exposure before you register. And so this is really important, especially again, if you're down the road, you're looking to sell the company, or just want to be compliant. You understand Nexus, you understand where you have to collect sales tax, you understand taxability. You want to start becoming compliant. You do all this review now, say, and say, look, the goal is January 1st, we're going to start becoming compliant everywhere. That's great, but the problem is what about for the last 3 years or last 5 years or even more? How long have you been selling into these states where you had Nexus and that you're selling taxable items? So you at least understand what potential exposure, if you get audited, there is. And the reason why now is the time to do it before is because once you register for sales tax in a state, any potential remediation generally goes away. And the most common remediation tactic is a voluntary disclosure agreement. Here it's called a VDA. And essentially what that process is saying, hey, look, the last 3 years, I should have been collecting tax in your state. I should have, I should have collected $15,000 in tax. Here's a check for $15,000. Bill me for interest because there's generally no way around it. Some states will waive it, most don't. But please don't, tax me. Don't impose any penalties on it. And so, there's two main benefits. One, a lot of states will limit that look back period. So if you should have been collecting tax in the state for the last 10 years, you could have, 20,000 every year you should have been collecting. If you were audited, there's no statute of limitations because it hasn't been started. That audit could really be a large number. Now, if you want to come ahead and come forward and go to the state and say, look, I want to do the voluntary disclosure agreement. What they do is they limit to 3 or 4 years, depending on the state, and say, you just pay for the last 3 or 4 years, and we'll waive anything prior to that, as well as penalties. Penalties are generally 20 upwards of almost 40% of the tax owed. So if you had $100,000 in tax in that 3-year period, if you were audited, you could pay anywhere from $20,000 to $40,000 in penalties. But if you did a voluntary disclosure agreement, those penalties would be waived. So it really comes down to a cost benefit and a business decision at the end of the day. Does it make sense to do a VDA, or do we really just want to worry about prospective compliance? Again, if you're looking to sell a company in the next year or two, that exposure is not going to go away until you file for 3 years or 4 years, whatever the statute of limitation is. So that might factor in. Does it make sense to do a VDA then too? Again, that could be a whole nother presentation. It's certainly a discussion with your tax advisor on, does it make sense to do it? But at least, look at it and make that decision. And maybe it's only a few $1,000s of liability in all these states. And we say, we can handle that. That's not material. Let's just register and kind of go forward. The only note I'll say real quick on the kind of prospective compliance, because that's probably one of the more common methods, is some states like Washington, for example, when you register, they actually require you to fill out a Nexus questionnaire when you register. So if you fill that out honestly and put, you had $500,000 in sales into the state the last 4 years, but you're just registering as of now, they're going to initiate essentially an audit and, go after you for those tax hasn't been remitted. Not most states don't do that. A lot of states just kind of, if you just register, there's no active review. It's just you can kind of register and go forward. But there are states, more and more states like that, or we've seen Massachusetts be really aggressive and Vermont, where you registered and maybe they have some information that you've been a pretty active seller in that state for the last few years, and they'll send a Nexus questionnaire then. So there's always that concern when you try to do prospective compliance that the state could come after you and kind of go after that prior period.
Right. In some states, what they're doing is they're waiting for you to file some returns. So if you file, let's say, 6 months of returns and you're well over that $100,000 threshold, they'll initiate an audit because they're like, hey, based on your filing history, we think you had Nexus before. So Illinois has been doing this. Arizona was doing this. So there's some states that are being a lot more aggressive than others. But it's something you want to know this beforehand, because if your exposure is $1,000 because you barely got over the threshold, it might not be worth it. But if it's 100,000, definitely we want to find some way to remediate it and get some of those penalties waived.
Yeah, thanks, France. And next slide. And I kind of jumped into the next slide. We kind of already hit all these options. But again, just super important. Know what's out there before you start registering in states. A lot of times, if you do, select, hey, I want to go with Avalara and use their software, great. But what they're going to do is they aren't going to really consult you on this part of it, and they're just going to start registering you and start, prospective compliance. So make sure you have the discussion with your tax advisor. Call us. We're happy to help. At least have discussions so you know what's out there before you start making these registrations. And with that, I think we go to the next slide, and I'll pass it on to Rance.
Awesome. Thank you, Steve. So we're going to go into a couple of nuances we have with taxability. And the first category we have is called a customer-based exemption. And so this is, like Tom was saying, you have a PIN that's subject to tax. What if my customer is exempt from tax? Usually at that point, they're going to be giving you a resell or exemption certificate claiming this exemption, so they won't be charged tax. And usually states will have these exemptions for various things. Sometimes it's industry specific. So a lot of states will have manufacturing exemptions. And so basically they do that to spur economic activity in their state. There's also exemptions for agriculture, nonprofits. They don't want to punish someone for trying to do good and have a nonprofit organization. And there's a lot of other ones. We just think, I have some credit union clients, and it's very weird because like federal credit unions might be exempt from tax, but a state credit union might not be. But usually with these kind of customer-based exemptions, it's not your responsibility to determine if they're exempt from tax. It goes back to kind of the general rules. If you sell a tangible item, it's going to be taxable unless the customer will claim that exemption. So they're the ones who is responsible for giving you that fully completed resell or exemption certificate. The next category we have are what are called product-based exemptions. So this is more difficult, and this is kind of on you as the seller to know these rules in advance, because based on what you're selling, they could be exempt from tax. I think Tom mentioned earlier that, drugs could be one of these categories. So in a lot of states, if you have like a prescription drug, a lot of time it's going to be exempt from tax. So you have to have the ability to code that in your system to know that, hey, this is a prescription drug. It can only be sold with a prescription. It's exempt from tax. Whereas if you might have over-the-counter drugs, and those might not be exempt from tax. And usually if it's a product-based exemption, the customer doesn't have to claim that. That's something that you have to claim yourself. And so one of these might be something like clothing. So some states are not going to tax clothing because it's a basic human need. Other states will tax clothing. And then you have some weird states like New York, which will say, hey, clothing isn't taxable unless it's over $110 per item. And that's where this gets really complicated when you're trying to deal with a platform like a Shopify, because you'd have to be able to try to code in there. It's like, okay, this specific item is over $110. It's going to be taxable, but this one is under, so it's going to be non-taxable. So it gets very, very difficult to do, especially when you're dealing with these product-based exemptions. And that's the benefit of having a tax engine like an Avalara, Vertex, or a Sobos, because they're making those determinations for you. Because you would take your clothing category, code it to their predefined clothing categories, and it'll determine based off of the price that the customer is paying whether that's taxable or not in the different states. So that's one of the specific areas that we deal with. We have a couple of clients that deal in supplements, so that's very specific too. Could be if it has a nutrition facts label, could be exempt. If it has a supplement facts label, it might be exempt or taxable. So you really have to dive into it. And the most complicated area that I've seen is food. If you sell anything food related, it's extremely difficult to determine taxability. To give an example, I believe it's in Ohio. If you sell a Hershey's bar, it's chocolate, it's subject to tax. But if you sell a Kit Kat, it's exempt from tax. And you're like, wait a minute, these are sold side by side in this grocery store. How is one taxable and the other one isn't? Well, a Kit Kat has wheat in it. And so what they say is if it has wheat in it, it is food, it is not candy. So there's very, very specific nuances when you're dealing with food. So if you are selling multiple things on your website, you're hitting a lot of different product categories. You could be hitting some of these product-based exemptions, and you would need some guidance on how you can and cannot tax those. Other difficult things, we deal with software a lot in our industry just because it's very complicated. Usually you're dealing with a lot of startup companies, and they might know how to tax software in their state, but maybe not other states. But it really does depend on the delivery method. Because when you think about it, software, 10 years ago was delivered on a disk. A disk was a tangible item, so it was subject to tax. And then it's like, well, now software is downloaded. Well, that's not tangible anymore. So how do states tax that? Unless states will tax downloaded software. And now most software is delivered in a software as a service model, and even less states tax that. So you can have the same product, but based on the delivery method, it could be taxed differently. A good example of that is QuickBooks. So you can still go buy QuickBooks on a disk. You can do QuickBooks online. And I'm in Texas, and QuickBooks Online, it has a 20% discount on sales tax. Versus if you buy it on a disk, it's 100% taxable. So 100% versus 80%. There's these weird nuances, and it does depend on a state-by-state basis. So having a taxability matrix can definitely help in these decisions. And then also having the tax engine to make these decisions for you can help, get rid of some of these taxability nuances. But of course, with the tax engine comes the cost associated with it. And then we mentioned earlier about the exemption certificates when we were talking about how to prepare for a sales tax audit. This is probably one of the biggest issues we see, is just getting them and having them fully completed. So please make sure that if you are preparing for an audit, or we suggest a lot of clients kind of do it every couple of years, refresh just to make sure you have everything up to date. That would be great to make sure your customer-based exemptions are being accounted for properly. So I do see a question that came in. It says, are there any special sales tax details exist when it comes to subscription-based or products or recurring billing cycles? So this is pretty difficult to do depending on what software you have. And we've seen this happen a lot, where let's say you sell software, but it's on a recurring basis. So you bill, once a month. Some of the software that I've seen, it doesn't really have the ability to track sales tax very well. So you kind of need to bolt on or to be able to program it, but your customer's probably not moving. So this might be one where you can manually charge them the tax and have that in there to recurringly charge them the tax, but you have to worry about rate changes, things of that nature. Another thing to think about if you have recurring revenue like that goes back to economic nexus. So when we went to those general rules, the general rule was 100,000 of sales into a state gives you economic nexus, or 200 separate transactions. So if you have a recurring, you bill them once a month, that's one customer, but now you have 12 separate transactions. So if you're selling in estates that have that transaction threshold, it doesn't take a whole lot of customers to reach economic nexus to get that 200 separate transactions. So it's something you definitely need to watch out for because it can or cannot be taxable depending on what state you're in. So definitely, if you need help, definitely reach out to your tax advisor, because there are a lot of nuances that come into this, and we're just hitting some of the general ones right here. So if we go to the next slide, I'm going to go over another big topic that we see a lot with inbound companies, and this is drop shipments. So if you're not familiar with drop shipments, what we typically see happen is the customer orders something online from a retailer, an online retailer, and they don't have the inventory in stock. So what they do is they either order the item from another retailer or they order it directly from the manufacturer. But instead of the manufacturer shipping it to the retailer, repackaging it, reshipping it to the customer, basically the retailer says, hey, I'm going to buy this from you, but ship it directly to the customer. So that's what they call a drop shipment. You're shipping it directly to the customer themselves. So as you're seeing now, there's multiple parties involved. And so to determine how you're supposed to handle this transaction, it gets a little difficult because now there's 3 parties, there's 2 separate sales. So in a lot of states, what the states will say is, hey, if you can get a resale certificate, please get that. And then that'll be the reason why you're not required to collect or remit tax. But Nexus really comes into play here. Because if you're an inbound company, and let's say you only have Nexus, I see this a lot, they only have Nexus in Florida because that's where their warehouse is. And so they only worry about sales tax in Florida, but then their customer is in California. And so they're buying an item from someone and then the manufacturer is shipping it directly to California. Well, California is very specific in drop shipments. In order for the retailer to not be charged tax, they have to be able to issue a California specific resale certificate or a multi-state certificate that has a California permit number on it. So if you only have Nexus in Florida, you're only finding in Florida, if you can't provide them with that certificate, the manufacturer actually is required to charge you sales tax. And you're not the ultimate consumer. So this gets really frustrating, but we can kind of help walk our clients through this process. There are some states who have ways to get around this. And on the next slide, there's a lot of ways you can provide exemption documentation. So you're not getting taxed when you're not the end customer. The first one is called the MTC exemption certificate. A lot of people will call this the multi-jurisdictional certificate. And basically, this is a certificate that states got together and said, hey, this is the form we're going to use. All of our states have very general requirements. And so let's just all agree that instead of having to go get 50 different certificates, let's have our customers fill out one, and it'll apply to all the states listed on there. And so I believe there are 38 states on that MTC certificate. So whenever you're getting a resale certificate from your customer, that's the one we see most often just because it has the most states on it. There is another multi-jurisdictional form from the Streamlined Sales Tax Agreement, and basically it's very similar, has similar rules, but it really is catered to the states that are signed up for Streamlined, but it can apply to other states as well, as long as it has the same general requirements. So we do see that one occasionally. It's not as popular as the MTC one. This is kind of weird, but some states will actually allow you to give an in-state certificate, even if you're not registered in that state. So if for some reason you're drop shipping something to New York and your vendor's asking you for a New York certificate and you're like, hey, I'm only registered in Florida, you actually are allowed to fill out a New York certificate and you put that you're not registered in New York, and it can still apply even if you're not registered. The next one is an out-of-state certificate. So if you're only registered in Florida, you give a Florida resale certificate. That can apply in a lot of other states because you're proving that, yes, it's for resale. You just aren't required to file in that state because you don't have Nexus. This other category is very, very odd. It's like you can get a certificate from your customer's customer. So if I'm the manufacturer, my customer is the retailer, but let's say they're not registered in California, so they can't give me that certificate. But the ultimate customer is in California and they have a resale certificate because they're going to resell to someone else. Well, that can flow through as long as the state allows the customer's customer provide you a certificate. So I occasionally will see this. Sometimes it'll apply if there's like a manufacturing exemption or something that the ultimate customer is claiming, but that can't apply. And then if they can't provide you any sort of documentation within that, usually the manufacturer retailer will charge you tax because they're required to, because it goes back to the default rules. If I'm selling a tangible item, it's subject to tax unless an exemption applies. And if it's a customer-based exemption, you have to have some sort of documentation to prove that it's exempt from tax.
I just want to reiterate here, right? A customer telling, contractual terms, we see this a lot from our clients where they say, well, yeah, right. So I didn't charge sales tax, but contractually, we say in the contract that it's the customer, our customer's obligation. States don't care, what the contractual terms state, right? They're saying, look, if you have enough of a substantial presence, if you have Nexus in my state and I essentially audit you before I audit your customer, I do not care what your contractual terms state, because essentially you can still indemnify yourself, right? But I'm going to collect the tax from you, retailer, even though it's essentially an economic burden of your customer because I audited you before I audited them. Go ahead and try and get that tax back. You have every right to do that, but I have every right as a state, if you have Nexus, to collect that tax from you initially.
Right. The way I like to explain it, there's a difference between sales tax law and contract law. So the state is going to use sales tax law to say, hey, as the seller, you were required to collect and remit. You didn't, I'm assessing you. But contract law is separate, and whatever your agreement with your customer is, you might be able to go back and back bill them for the tax. But that's separate. The state doesn't care about that whatsoever. Awesome. So we're towards the end of the sales and use tax piece. I want to give Jill some time to kind of go over some of the federal tax implications. But if y'all do have any other sales tax questions that you're thinking of, please feel free to throw them in the Q&A and we can connect at the end to kind of go over any remaining items in there.
Yep.
Thanks, Ryan. Next slide. Thanks. Leave it here just for a moment. I know it's weird. It's just a bike. So from a U.S. federal income tax perspective, which I understand is a very strange gear to suddenly shift into, but Tom and Steve and Rance had invited me to join here because if you do have a foreign corporation that has moderate, at least, sales to U.S. customers or clients, it's a good idea to give those clients, well, the foreign corporation at least, a heads up that they might need to be doing some income tax filings and following some federal income tax obligations as well. And so it's very common for a foreign business that has U.S. customers or clients to at some point ask or be prompted by a sales tax advisor, should I be doing something from a federal income tax perspective? Should I set up a U.S. subsidiary? Okay, next slide, please. Thank you. So when that question gets asked, there's a lot of things to worry about there, or a lot of questions to dive into. A foreign business can choose to continue to operate in the U.S. directly without forming a U.S. subsidiary of any kind. or it could use a foreign subsidiary, which does not necessarily mean a corporation. The US has a wide palette to choose from of legal entity forms to operate in. The only one I will say just now, just to be responsible, a foreign person or entity cannot form an S corporation in the US. So that's off the table when we're talking about an inbound business. And so the question really, in addition to what type of entity should we form, when to pull the trigger on that entity, when should we form a US entity if we've decided to do so. It's going to really depend on a bunch of factors, only one of which is going to be actual tax. We've got commercial and legal considerations. So for instance, if we have a foreign corporation and the customer base of that foreign corporation is the Department of Defense of the United States, and the widgets that are being sold are very important widgets that go into fighter jets, it might be that the US government would require a US corporate entity in the US to actually do business with. So that would be sort of a commercial and legal consideration there. And then also tax reporting preferences and other tax implications, such as sales tax. So earlier in the presentation, you saw that there's some hiccups surrounding issues of remitting the tax, setting up a US bank account, those types of things. And those are things that do need to enter into the conversation when discussing what does our business model look like going forward if we do form an entity and in the US, and also how can we best use this entity to make sure that we're covering all of our obligations overall. And so, yes, but one of the biggest decision points, obviously, is what are the federal US income tax implications of doing business how we have been doing it, as opposed to setting up a US entity. Next slide, please. Thank you. So this is often a surprise to foreign corporations or foreign individuals when a US income tax return is required to be filed. Part of that may be because many countries outside of the US only require that an income tax return be filed if the company locally, if the company has profit, or if the company has something called a permanent establishment in that country. The US is very different from other countries in this way. And so often we have a situation where the first time I'm consulting for a foreign corporation that wants to know if they should form a US subsidiary is they've been doing enough business in the US over the last few years that they probably should have been filing a US tax return all along. It's just not well publicized because it's boring. So the general rule is that a foreign corporation or an entity or individual is required to file a US federal income tax return anytime they are engaged in a US trade or business. This term, US trade or business, or engaged in a trade or business within the US, is used all throughout the Internal Revenue Code, all throughout the Treasury regulations, and not only in this specific context. And despite the fact that it is used a lot in our law, it is not defined, except for through case law. So folks operating a business in the US or doing some activities in the US, IRS will say that's a US trade or business. They fight back, and then the court will say, all right, these things are a US trade or business. And then another case comes through. The tax court decides, right, these things are not a US trade or business. So over the decades, we've got a fairly robust set of case law that will define what a trade or business is and what a trade or business isn't. It's actually a fairly low threshold. The boiled down version of it is the company frequently, continuously, regularly engaged in profit-seeking activities within the US. And so That's a very broad definition. And when you have a foreign business that is starting to have to worry about sales tax issues, whether for services or sale of goods, it's a good time to visit or revisit whether a federal income tax return might also be required. There may be exceptions. The fact pattern may not squarely fit within the definition of a U.S. trade or business, or not definition, but that concept. But it's good to look at sooner rather than later. This also, the U.S. trade or business concept applies when you have a foreign business that's invested in a U.S. partnership when that U.S. partnership is engaged in a trade or business. That trade or business of the partnership is attributed to that foreign partner and automatically means they have to file a U.S. tax return. And then a U.S. tax return is also required if the foreign corporation has or individual has been withheld on some income from U.S. sources. That's not the topic here, but I did want to mention it. Next slide, please. Thank you. So if a U.S. foreign business is, let's say, engaged in a U.S. trade or business, the IRS doesn't get to tax all of that company's income. That's not all going to get caught in the U.S. tax base. It's going to be income that is effectively connected with that business. Again, facts and circumstances determination. It can be very arduous and detailed analysis that needs to be done in order to determine whether there's a U.S. trade or business, and then on top of that, what income is effectively connected with that business. Sometimes leads to some surprising answers. Now, do have a U.S. trade or business, the foreign corporation or foreign business, it's taxed on a net basis. It's not gross. And so on that tax return, just the way any other tax return, here's my gross income that's connected with this U.S. business. Here's my expenses and deductions that are also connected with this U.S. business, and here's my tax. There's also a gross basis taxation outside of the scope of this, but that only applies to incomes received that is not effectively connected to the U.S. trade business. Now, that might be all well and good. That's a very low threshold, as I said. Are you engaged in a trade business within the U.S.? That's what requires you to file the U.S. income tax return. However, if the foreign business is incorporated, located, resident in a country with which the U.S. has entered into an income tax treaty, that threshold for requiring the filing of a U.S. income tax return is increased. So U.S. trade business, very easy threshold to trip. Permanent establishment, that's the threshold for a person that's located in a country with the tax treaty. That's a little bit harder to me. That's going to require a certain amount of use of U.S. infrastructure, for lack of a better word. That would be when you still file the U.S. tax return, but you would make a treaty claim saying, hey, IRS, it looks like we have a U.S. trade or business. We may or may not agree, but regardless, we think that we qualify for a treaty exception under this treaty. We don't have a permanent establishment because we don't have any employees or agents in the United States. We don't have any use of any physical facilities within the United States, and if we do, it's just a warehouse. We're not dealing with any kind of construction or installation process. Those are generally the terms across many income tax treaties that the U.S. is party to. And so that's really the point of making a treaty-based return. But like I said, most countries outside of the U.S. do things slightly differently, where you don't have to file the tax return to make the treaty claim. You just don't file the tax return by virtue of deciding you don't have a permanent establishment. So this is why we've got inbound businesses. There tends to be a lot of education that needs to happen with respect to the US rules themselves, because it is so different from other countries.
And maybe, Jill, if I can take this opportunity here, right? You're talking from a federal income tax perspective, and we can also address, I believe, a Q&A. Excuse me. Rules for permanent establishment are different than Nexus sales tax Nexus rules. I mean, obviously it's a similar concept for different taxes, but to that point, you could have sales tax Nexus and not have a permanent establish, and potentially vice versa, but I don't know if you could even get there. The other thing we want to talk about is when we're talking about treaties, income tax treaties, you want to be careful, excuse me, from a state level to say, all right, well, state sales tax, these treaties don't apply. This is an income tax concept. And even more, consideration needs to be given. Okay, this is a federal income tax concept. There are states that can decouple from these treaties and say, I don't care what the federal government says from an income tax perspective. California, for example, I decouple from that. So that doesn't affect me. And sales tax clearly is not affected by these income tax treaties. I know there was a Q&A here that says, hey, if you're operating as an S Corp, are the tax collection rules different? I'm presuming the question is geared more towards a sales tax collection versus an income tax filing. And no, it is not. Sales tax really just looks at the legal entity. They don't even really have, for the most part in the sales tax world, they don't have these federal and state income tax concepts like disregarded entity or S Corp, C Corp. I mean, if you're a legal entity, regardless of what you are, and you're a retailer, right? And you're essentially the entity that's selling this taxable good or service, you are responsible for collecting the tax. So I hope that kind of answered that question on if S Corp collections. Dang it.
Right. And it does make me think of something that is relevant here. So, owners and officers are liable for sales and use taxes. A lot of people don't understand that. And so, when you are filling out those registrations, that's why they need that social security number. And so it goes back to, it is a trust tax. Owners and officers are personally liable. And so having the protection of an S corp or an LLC or other different entity structure doesn't really matter from a sales tax perspective, because it will go back to the owner if the entity can't pay.
Jill, back to you.
All right. I know everyone's so excited. So let's
Right.
see about federal income tax. Okay. Next slide, please. This is the last one, I promise. Okay, so I had mentioned earlier about that concept of when a foreign business can be subject to U.S. tax, U.S. income tax on a net basis. And that's if you have the U.S. trade or business, you have the income that's effectively connected with that trade or business, and you do have a permanent establishment. So you can't make that claim that you're exempt from U.S. federal income tax by virtue of the treaty. Now, separate and apart from that, a foreign corporation or individual can have sometimes items of U.S. income that are subject to tax on a gross basis. And that is usually accomplished via withholding, when the payor of that income is responsible for withholding the appropriate amount of tax on that income payment. And so this can happen. I did note in the top left there that if you're not engaged in a trade or business, you may still be subject to U.S. tax through withholding. Yes, that is absolutely true. It's a little maybe misleading now that I'm thinking about it, because it is also true that you can have a foreign corporation or individual that is subject to both. So you may have a foreign corporation that has a U.S. trade or business. It has income that is effectively connected with that trade or business. And it also may have income that is from U.S. sources, but isn't effectively connected with the U.S. trade or business. It would take too long to come with an example that would make sense with. So I'll leave it at that for now. The idea here, though, is that common ones that you'll see are going to be interest paid from a U.S. person, a U.S. debtor, to a foreign person. Rent, if a U.S. person is paying rent to a foreign person for use of property in the United States specifically. Also royalties. Royalties are very, very broadly defined. It's going to encompass licenses. It's really going to encompass any type of regular payment made to somebody for the use of intangible or intellectual property. When that intellectual intangible property is used within the United States, that's when the payment of that royalty is going to trigger a withholding requirement. And dividends, of course. If you do have a U.S. subsidiary and that subsidiary pays dividend to a foreign parent corporation or foreign individual owner, that's going to trigger a withholding requirement at the U.S. subsidiary level. Now, under U.S. tax law alone, taking the treaties out of it, the statutory rate of withholding on all of those types of income is going to be 30%. That is pretty hefty. So if you are dealing with the payee who is not in a treaty country, that's the rate that's going to happen, 30% of any of those types of payments. However, if the foreign corporation or the individual is resident in a country that the U.S. does have an income tax treaty with, then there are usually slightly lower rates, sometimes substantially lower rates. In some circumstances, the withholding rate is actually zero. There may still be reporting requirements, but zero is a much better withholding rate than 30%. And so if you have a foreign corporation or individual that has a U.S. payer that is requesting certain forms, it is a good idea to give the payer those forms. Usually it's going to be something along the lines of a W-8, W-8 BEN-E, a W-8 BEN, a W-8 IMY, a W-8 ECI. These are the documents that the foreign individual or corporation would give upon request by a payer to say, hey, I am resident under a treaty or not. If I am resident in a country that has a treaty with the U.S., under the treaty, here's the appropriate rate that you should apply. And then the payer will keep that for their records and ideally withhold the appropriate amount. So again, the focus here has been the state tax side. So apologies for sort of this intrusion, but Tom and I have worked together so frequently for the past 4 years now on inbound companies that I think it really is important for folks who are serving on one side of that SALT Fed tax side of the fence to at least have a general awareness of the other side, because it really is helpful in terms of giving our clients comprehensive service. So back to you, Tom.
Well, I think that's it. I think unless, anyone else on the panel has any other items they'd like to discuss, you guys have our contact information. I think, Katie, you will be sending this out to all participants or,
Yep.
whoever signed up. But, it was a pleasure on our end. I hope this was the same for you all as well.
Yeah, we'll kind of leave some time here at the end. If anyone has questions, now is the time to drop them in Q&A. I have our QR codes up here, so if you just want to check out our websites to learn a little bit more information, I'll also go back here. There's all of their email addresses there, and like Tom said, I will send out the recording and the deck within 48 hours. Looks like we have one more question. It says, can you provide a little bit more insight into the impact of marketplace facilitator laws on sales tax compliance for ecom platforms?
Sure. So essentially, we were talking about this economic nexus, and we're saying, all right, if you sell a certain amount of sales into a state, the whole point with marketplace facilitator rules states they're basically putting Amazon, as the retailer. So anything that you're selling through Amazon, Amazon now all of a sudden they have the responsibility to collect that tax. Even though they're selling your good, they are essentially deemed marketplace facilitators. So the impact that has, it's kind of two things, it's a nexus perspective as well as a taxability responsibility perspective. So the way it impacts your nexus is kind of two ways. Number one is, that economic consideration. Does, the fact that you sell 99% through Amazon Marketplace Facilitator and 1% through your own website, does that come into play? Does that 99% revenue stream come into play when you are analyzing your economic nexus footprint in the state, right? So if I have $1 of my own sale, right, $99 of Amazon sale, I think I should probably say it the other way, 99,000 of Amazon sale, 1,000 of my own sale, do I now all of a sudden have economic nexus or not? Most states, this is a generality, so I just want to make sure we're talking generalities. Most states will not include those Amazon Marketplace Facilitator sales in your nexus, economic nexus determination. That's one way. Secondarily, if you have inventory in Amazon fulfillment centers, right, that could give you that physical presence nexus that we spoke about, right? So that's a consideration. Well, okay, now all of a sudden, and I know a lot of our clients that we talk about, right, it's flash sales, so they never know. But to be honest with you, states are like, I don't care. You know exactly where fulfillment centers are. If there's one in my state and you're selling into my state, odds are your inventory has been here at some point in time. That could give you that physical presence nexus to where you're not even looking at economic anymore. Now, that being said, if your nexus is because you're in an Amazon fulfillment center and you're selling through an Amazon Marketplace Facilitator, how much do you really care, right? Yes, you have nexus, but that tax is being taken care of, presumably, right? That, in a perfect world, that's where it's 100% both. What you got to look at is, okay, well, I do a mixture of both for my own website and Amazon and that sort of thing.
Right.
So
something else you have to be cautious about is when you are the marketplace facilitator, a lot of people don't realize how broad these definitions are. But like in the US, you could be operating a flea market where people set up booths and sell stuff, and you're considered a marketplace facilitator because you're creating a market for them to sell their goods. So if you have an online website and you're selling other people's goods on it, you have to watch out because you might unknowingly become a marketplace facilitator based on the amount of sales going through your website. So definitely, if that's you, reach out because you're personally liable for the tax, and it could catch you off guard, especially if you're in the startup phase, and because that's a really big obligation. And we do know that the software providers have some marketplace facilitator software to help with that as well.
Thank you, Rance.
Awesome. Thanks, guys. It doesn't look like any other questions came through, so I think we're going to go ahead and wrap it up. But I really appreciate all of you being on today. Oops, sorry, I'm hearing an echo, so if you're hearing it, apologize. But I really appreciate all of you, the audience who tuned in, and then of course our panelists for being here. We really appreciate it, and maybe we can do this again soon, and it'll be just as much fun.
Yeah, right. Thanks, guys. Thank you so much. Thanks,
Yeah,
everybody.
Thank you, guys. Have a great one, and we'll chat soon.
All right. Bye-bye.
See you.